Let's talk about the mystery charts and the methodology in action. The mystery charts, in case you were wondering, come directly from my trading service. Now, that might be a mystery chart here or there that maybe a stock or something we talk about in the Facebook group or something, but for the most part, I'd say 99% of all the stocks come straight from my trading service. So this one was recommended a few days ago, and the reason it's not a mystery chart is because if I would have recommended it before last Thursday, then it would have been in Thursday's show as a mystery chart. So hopefully that made some sense. But you can see all of these. I'll give you the archive information just 1 second. Anyway, this thing was in a really nice trend, nice longer term Landry light in place. I didn't notice a Landry light until I was putting together this presentation. So I have it as a TKO, but it's also a Landry light pullback. And Landry light pullback, you just want 10, ideally 20 or more days of Landry light. That's the lows greater than moving average, as illustrated down here. And then you want to pull back to the moving average. So it goes from some number 10 or greater back down to 0. And then you look to get long as the trend resumes. Anyway, I had it as a TKO. You can see it made all-time highs here. And it's a bit of a double top knockout. So a double top knockout, you want a high surrounded, or start that over. You want a high with a couple of lower highs in between, 3 or 4 ideally, and then another high. So that's kind of like a mini double top, and that gets people to thinking that maybe the stock is topped out, maybe it's in trouble. And when it sells off hard, it vindicates the shorts, and it also shakes out a few nervous longs. That's the whole theory behind the TKO. And so the TKO in this case is kind of like, I kind of like use my mind's eye and kind of blend those two bars together. Let me just rewind that. You see these two down bars here? Well, this one's down and this one actually closed up a little bit, but it did go lower. So that's your knockout move over 2 bars there. And then the entry was at 26.25, 21.25, and the IPT is way up here off the charts, so to speak, at 31.25. So that's 5 points and all that. Fairly volatile stock. That's why I call for such a fairly wide stop based on the stock price. And let's see what's happening. So far, so good on that one. Knock on wood. All right, so we have a mystery chart update. This was TPR. The entry 71.50, stop 81.50, and then IPT of 61.50. Again, like I said last week, it did form a bow tie. It was a little sloppy, so I called it a first thrust forum. Ideally, with a bow tie, you want them to come together really tight and spread out to look a lot like an actual bow tie. And I'll show you an example of a tight pattern in just 1 minute. So a tight pattern would go straight from green to red, or maybe have 1 or 2 bars of yellow, maybe 3. But in this case, you had a few bars of yellow. So it was a little bit more on the sloppy side, but that's okay because we do see that the trend has turned, and we do see that the market has pulled back a little bit, finishing up the setup. So with a transitional setup, you're looking for that market to roll over, and then you're looking to get on at the first little bit of a pullback or retracement. Now, you won't always get a deep retracement, or you can't sit around and wait for a deep retracement, I should say, because with these transitional patterns, the idea is to get in and catch the most people off guard. When a market breaks, its first break lower, you have anxious shorts that pile in, but then you also have a lot of nervous Nellies that get shaken out. Now, the people who are previously long the stock, the longer term holders, they start feeling the pain, but as a general statement, the public does not sell when a market goes down. They tend to sell when the market goes back up. Now, in this case, after a strong sell-off and the market's still at fairly high levels, historically speaking, right, they're not feeling a tremendous amount of pain. They're beginning to wake up a little bit. And then when that market begins to drop further, the pain index begins to increase. So everything I do has a bit of a psychological backing from a technical analysis standpoint. So a lot of times technicals get a bad name. It's like it's mumbo jumbo because of this complex indicator does this, and the wave count of the arcane whatever does that, or Mercury goes in retrograde. But the real technical analysis, just looking at the charts and figuring out the psychology of the market at the same time, not imposing your own personal psychology on the market, which we'll dig into in just 1 second. But anyway, with the transitional setups, you have a lot of people that are caught off guard, and a lot of people, like I just said, who are waiting for that rally to sell. And if that rally doesn't come, then they might be forced to sell for reasons which have nothing to do with the underlying stock, more so fear of losing more money or needing money, as especially when you're in a bit of a bear market phase like we are now. I hate to label it, but as a general statement, it's generally bearish, right? My Kunas just somebody said, "Where are you from?" I didn't know you were Kunas. Like, oh yeah, every night at a webinar it'll slip out. I just said bearish, so I'm a little bearish at the moment. Anyway, entry was here, stop was way up here, and you could see we took a little heat at first, and of course I'm thinking, here we go again. It's a short side. Short side's a real pain in the ass, and I'll talk about that in more detail, especially if this bear market or whatever we're in drags on. But anyway, it did fortunately turn back down, and the IPT was hit. Now, when that happens, when you hit that IPT, you're going to bring that trailing stop down, okay? And then you're also going to exit half of your share. So now you have a free roll, so to speak. And barring a huge overnight gap, which of course could happen lately, right? The worst could happen is break even on the remainder. And you want to position yourself, and I did not do that in a minute, I want to show you, but you want to position yourself where you have the potential to hit a home run, the potential for unlimited gains. I firmly believe if you're trading without the potential for unlimited gains, that you're not going to make it in a business. So I see a lot of these people with these selling options or so-called income producing strategies, and I'm getting flooded with a lot of those lately. And it's like, you know, that'll work until it don't. You occasionally going to get whacked really bad in the markets, and then in order to recover from that, you're going to need the occasional somewhat unlimited gain on a position. Anyway, if you want to see the archives of these, the newer ones, what I've been doing, which is pretty cool. One of my clients from Italy, he's been begging me forever, and I feel bad not that I didn't do this sooner. I just thought it would be a lot more trouble. But he's been begging me forever to put the services up on YouTube so he can read them, or I'm sorry, watch them and read the translation. And YouTube's got a pretty good translation algorithm. It's an AI type of thing. So the newer ones are going to be youtube.com/Dave Landry. So for instance, like once the setup of the day, the mystery chart as it soon becomes, or the mystery chart, whatever, how you want to look at it. So the mystery chart would have been AGI, again, had that set up before last week's show. But after it triggers, I'd go ahead and make those services public. And on the service page, it takes me about 2 or 3 weeks or so to put them in the archives. But the archives are going to have the much older services, because I only started this YouTube thing a little while ago. And just not to digress too far, if you are looking at them on YouTube, I can see my video numbers dropping right now. You'll see a big gap because I was putting them up there, the delayed ones up a while back, and then I stopped doing that. But then I put the ones live for my international clients, and then make them public for everybody else as soon as the setups trigger. Anyway, so that's where you can find all this stuff in case you're wondering. So the idea, again, not to beat the dead horse, but it's funny. It's like if I don't explain everything, I get a lot of emails and questions that people say I use a lot of inside jokes, and and I do, but I want to try to explain it as fully as possible. So just bear with me for a second. So we buy the entire position at once, or in this case, we short the entire position at once, and this was 200 shares. So 100 shares is going to be for trading. That's going to be the swing trade loaf, and 100 shares is going to be for, hopefully, what will turn into long-term profits. This is where your money is. This is what keeps the lights on and keeps you in the game. Win a little, lose a little, win a little, lose a little. And hopefully we risk 2% max on each position. So hopefully your worst loss per, let's say, 100K account would be $2,000, and then your best gain would be much bigger. Now, it doesn't happen often, but every now and then we'll get one that'll do 10 times that amount, $20,000 or so of that loss. Now, we do get a few stinkers in a row too, and somebody raked me over the coals not that long ago because they had 3 losing trades in a row. Might as well demonetize now. Shit happens, okay? And if you've been trading for more than a day, I think you probably know that. By the way, I'm getting a lot of phone calls from friends and family worried about me. I'm fine, but it's like when things are bad for me is when the market is kind of slowly making that transition but continues to go higher. That's when it's a little hard for me to readjust, and for any trend follower for that matter. Or if you have a trend that does this, and at the end of the year, you're here and here, but you did this the whole year, and it's hard to follow that trend because the trend keeps knocking you out. That's part of the program. Once you get a fairly solid trend in one direction, you should do just fine. But anyway, that's the trades. Let's see, 60. That bounced a little bit yesterday, and where are we now? Yeah, we're higher than that spreadsheet, so that's a much smaller number now. But you know, they ain't over yet. Last week, just real quick, just to fill you in, because I want to kind of close the loop with some of this option stuff. For S&Gs, in order to establish a position, I needed to be short 200 shares of this in my model account at least. I do trade other accounts, but I do try to keep one as a model for these teaching purposes like we're doing today. And I saw the 71 puts were 25 cents, and I'm like, you know what? I can get in those puts. Then I have a position today, because it's set up triggered. And should the stock come unglued, I have a position. If it rallies or whatever, then I'm out $50, and then I'll figure it out from there. And then I decided that, okay, let's go ahead and establish my position. And so I bought a fairly deep in the money put as a substitution for underlying stock. Now those 0 DTE options did expire, so I had to unload those. If I was doing an S&G trade, like if I bought like 10 of those 71s for $250, and again, I was just trying to mimic the model account. It's like, oh crap, this thing triggered. Instead of shorting 200 shares and put up $14,000 worth of margin, I'm like, you know what? For $50, I can get a position, and then I'll figure it out from there. And then within the hour or so, that's when I put on the position, so to speak. And that was the 2 April 17 puts at 465. But anyway, I flipped out those 0 DTE options in today, and I picked up $140. You can't do that all the time. My point here, even if it went to 0, I'd have been okay with it. The point was that sometimes, especially with these 0 DTE options, you don't have 0 DTE every day. This happened to be, these options happened to be expired on the same day the setup triggered. But if you can get in a position super cheap and then figure out how you want to position either in the underlying or via options, I think it's worth a shot. So like I said, even if that went to 0, I was completely okay with it, and I decided to let it ride. Now, just to rewind a second, what I was starting to say was, and I think I said this last week, if I was going into an S&G type of position where I bought like 10 of them, then I would immediately put an order to flip out 5 at 50 cents to pay for those options. So turn $50 in the options, 5 at 50 cents would pay for the options, and then I could figure out how I'm going to trend follow on the remainder. Anyway, so I took profits when it was 500%. I figured, let's not get greedy. That's enough at 125, and then the other one. Now, here's the puts that I bought. And again, I bought the 75 puts. They were about 4 points in the money or so when I bought them. And again, that's to try to mimic an underlying position in the stock, a delta of 100 or close to 100 per contract, means that it acts like 100 shares of a short. I guess your option people say, well, Dave, that'd be a negative 100. So, okay, I got you. A negative 100 delta. And fortunately, I was looking for a double, but with the deep in the money options, it's a little trickier to get that double. If you're playing like a gamma play or something where you're looking for that explosion in gamma, like the aforementioned 25-cent 0 DTE options, then by all means, you can look for a double. But when you're playing deep in the money options, it's a little bit different story. Now, in an ideal world, you would wait for that initial profit target to get hit, and then you take profits in your options. But the option world is a little tricky. And sometimes you have to, like I said last week, feed the ducks while they're quacking. So even though the IPT wasn't exactly hit at that moment, I went ahead and, because I had nearly a double in option, I got out of them. And then I got out the remaining options for 12. So that turned out to be a decent trade. You add all up, that's 1260. And there's all the trades down there. Now I have one additional trade I wanted to show you here. First thing I did was I rolled down the 75s to 71s, okay? And at this point, I only needed one put because we were short 200 and I took off 100, so I only needed one, so I bought one of those at 6. And then here is something I did, and I was on a webinar the day before, And I'm like, geez, I wasn't sure what to do. I had a fairly deep in the money option, and the options further out were so expensive. I wasn't sure what to do. And it's like, I could put it a spread, but boy, that complicates things. And then I was at a webinar, and an options expert, the options professor, was like, well, why don't you just put on a spread? I'm like, I thought about that, but then it increases the amount of moving parts, and I wanted to have an unlimited potential, but then I decided to do it anyway. Now I'm going to backtrack on whether or not I should have done that in a few minutes. But before we do that, let's just kind of take a look at what's happening here. So there's all the trades, 955. And then I did the options trade, the spread, which I'll come back to in a minute. Now, JBL was another one. And again, another transitional pattern. This is a slightly cleaner bow tie. I think the CCL is even better. But you can see we have a bit of a double top happening here. Okay, so the stock then begins to roll over a little bit. The bow tie forms, and we have a pretty serious thrust down. This is a nice deep retracement. Like I said, on the short side, you can't always sit around and wait for that deep retracement. Entry was here, the stop was up here, and the IPT was down here. So we did hit that IPT on the TPR. I'm sorry, the JBL. And because of the gap entry and the spread around the time it entered, or triggered, I should say, we got it at a little bit lower than the normal entry, or the suggested entry. And then the stop comes down to break even and then beyond, okay, once that IPT is hit. And we got knocked out of that one yesterday. Now, I still have an options position on this one. One advantage of options is it does give you staying power. And if memory serves, I may have rolled those options down, but they were not worth much. In a case like this, one contract left, I just let it ride. But you can see that when I took this, the snapshot is actually after it stopped out. So if it's white, it means that the trade is done. So you can see right here, it's stopped, and this is straight from the spreadsheet. You could actually see this. To be able to see it today on YouTube, it's under the playlist Dave Landry's Core Trading Service. So it's youtube.com/Dave Landry. Anyway, so that's how to trade it up. Not an ideal situation. I wanted this bottom number to be much, much, much bigger than this one, but this is kind of a better than poke in the eye trade, roughly $1,300 over a fairly short period of time. So I know it's not a good idea, but if you annualize that, if you could do that, this is like a week and a half, maybe 2 weeks. If you do that every couple of weeks, percentage-wise, that's huge, right? 1.3% gain on your account. I know it's a little fuzzy math. Here's a CCL. This one is fairly tight bow tie in here. Now, it's probably not as good as this snapshot, which I took yesterday right now because we had the big rally in there. Actually, it's better today. It's down 2 and change. So it's looking pretty good again. So it's probably over 1,000 now as far as open profits. But anyway, we had the bow tie here, fairly tight bow tie in this situation, not a whole lot of yellow, a couple of days of yellow down here. Yellow is when the moving averages, 10 simple, 20 exponential, 30 exponential, are not in uptrend proper order, meaning that one's on top of the other, 10 greater than 20, greater than 30, and then vice versa on downtrends, okay? 10 less than 20, less than 30. And if they're neither uptrend or downtrend proper order, it's 0 as far as the count, and then it's illustrated down here as yellow. But you can see we did make that switch from the green to the yellow to the red. That suggests the trend has changed. And again, this is coming off an all-time high. Everybody who's ever bought CCL is happy a few weeks back from the bow tie, right? And then as the stock begins to drop, it creates more and more pain and the psychological issues we talked about a second ago. So it pulls back to complete the pattern. Now, in this case, we didn't have a nice deep pullback, but on the short side, long side's a little different. Long side, I like a nice deep pullback unless we're in a long-term bull market that's very orderly and we have little bull flags along the way, that's fine. But on the short side, you can't sit around and wait for that nice deep retracement. And it's a bit of a leap of faith by shorting these shallow pullbacks, but you have to do it. Anyway, the entry was there, stop was up here, IPT was here. And again, when that IPT is hit, you bring down the stop and the remainder to break even. And in this case, if it continues to move in your favor, what I do is I trail more loosely to hopefully ride out a longer term trend. Now, longer term trends on the downside, much harder to ride out than on the long side, but we're going to give it a shot, and as we often do in these bear markets, as we do in bear markets. And the one thing I was kind of thinking about with the short side that's kind of cool is right now, I forget what the point stop is on this one, but let me just pull a number out there, 5 points maybe. That sounds ludicrous, but that's probably about what it is at least. One thing cool about the short side is as the stock drops in price, you can maintain that 5-ish point stop. I did let it open up a little bit, but you don't have to open up as much as you do on the long side, because percentage-wise, as the stop drops, that stop gets wider and wider on a percentage basis. So kind of a cool thing about the short side. There's not a whole lot of cool things about the short side. But anyway, here we go. So this particular, I knew this snapshot was bigger. Okay, so this snapshot is bigger than what's actually there by a little bit, not too much. But that's the idea, to capture that longer term trend on that remaining loaf. I probably need to get into a lot of I talk about them often, but I probably need to get into a lot of the nuances of trend following, and I probably need to make a note about that. But it's like when it works, it's like butter, but it doesn't always work, unfortunately. Anyway, here's all the TPR trades, and so I had these puts at 465, so I bought the 75s. And then again, I sold one at 850. So we take a look at that. So that's minus $80 total on the trade. So not quite a break even because we didn't get the double. Now, the other thing I did was I rolled down the 67s to 60s. I'm sorry. So after the, let me just rewind a second. So those were 75s. And then I had rolled down to 67s, okay? So I had one put, and it cost me $600 at 67, and then I decided to short one put, thereby creating a spread. Now, I'm not suggesting you do spreads. I just couldn't. I wanted to roll down, and it just wasn't. It wasn't really feasible to buy those options that were further down. Now, in hindsight, I did make some mistakes here, which I'll get to in 1 second, but I didn't realize that I'd already rolled down that position. And when I saw it was in the money by quite a bit, I'm like, holy moly, I need to roll those options. And I didn't realize I'd already rolled them. And that'll make sense in 1 second. So based on this position, the maximum profit at expiration would be $395 if the stock closed at precisely 60 and that option expired. Worthless, that short option, okay? Now, the max loss would be $305. Now, spreading versus rolling down during high implied volatility times. So again, my idea was that, okay, this implied is so high, I could sell this option for 3 points, and even if the stock drops 3 points, I'll break even on that position, and my long option position will cover it. One problem with that, though, is I violated my rule of not having open gains, okay? So I think part of me wanted to do this for SOGs, and I'm just kind of talking this out right now. But in this particular case, the lower strike out of the money options were too expensive to buy, and I was at a bit of a dilemma because the deep in the money options could easily evaporate. Now, I wasn't thinking in terms of the whole position and all the other trading that I'd done prior. So the potential 395 gain versus a 305 loss doesn't add up. However, and this is where it gets tricky, right? On rallies, a short put can be bought back in and reset on a drop, rinse and repeat, or is that just wishful thinking? And that brings another problem into the equation. And let me talk a little bit about it. I was going to talk about it in a second, but let me just jump into it right now. So one thing I've been working on a lot, and I'm going to show you a little bit of that, kind of a tangent from that, is what do you want, okay? What do you want? And ideally, what you should want is to be in tune with the market. What do you want? Well, you want to position yourself for potential unlimited gains should that elusive big trend come along, and I should say when that elusive big trend does come along. So in this particular case, when the second I put on that spread, I start watching the market starts dropping, and that short option goes up in value. Okay, and I'm like, crap, down, down for me, up for whoever's long. And so I'm thinking like, well, what do I want? I'm technically should be short this stock. Do I want the stock to drop? Yes. But then if the stock drops, then the short option goes up in value. And it's like, okay, well, now I'm kind of stuck holding it for some time because I need to let it all play out, right? Because I collected my $3.95 or whatever I did on that option premium. So it becomes kind of tricky. It's like, well, what do I really want? Well, now what I want is I want the market to retrace. So I'm going to lose money over here, but I can get out of that option, and then I want the market to roll back over. That's a lot of wants. Okay, that's a big ask. Now, technically, the market will bounce from that oversold quite often and then roll back over. So maybe you could rinse and repeat. I don't know. I think I'm adding too many moving parts to the equation, and I would certainly open this up for discussion. But I think, and I'm getting a little ahead of myself again, but I think that I'd forgotten that I'd already rolled them down, and all of a sudden I see these options are 5 points in the money or whatever, and thinking that, well, I'm kind of stuck in this position because the volatility is so damn high, the implied volatility, and even the at the money options like $3-4. I can't buy those. So that's why I thought about that. And again, there's a danger for not allowing for open-ended gains. And here's the thing that complicated it even further. And again, I'm getting ahead of myself, but let's just get out of the way. So I'm thinking like, oh, geez, I don't want the market to go down because that short option is going to go up in value. But in another account, I didn't do this experiment, so I really want the market to go down. So the more confusing things you put into your brain when it comes to trading, as opposed to I like it to go down, I like it to go up, the more animosity you're going to have. So again, with these options, when you're doing something like this, the number of moving parts increases dramatically. So there it is. I sold the option for $2.95, and I just immediately put in an order for $1 because I thought that'd be a great trade if it happened, right? And it did get filled, so I made $1.95 in a short option. So it worked, didn't it? Well, it did, but the problem again is I didn't allow myself for open-ended gains. I created a lot of mental animosity, and so I think in the future, never say never, but I'm less likely to do this again. But what I will do is, if I am in a situation similar to now, if that option truly is really, really deep in the money, and I can't let that, let's say I'm 20 points in money, and I can't let that option retrace, and the at the money options are like 100 and something percent implied, maybe I might consider selling some further out the money or somewhere around that options. I got knocked out of something. Anyway, hopefully that made some sense. It's like there's always a danger in increasing the number of moving parts versus just a flat out directional play. Now, options players who are successful, I should say, they understand all these moving parts, and they're okay with they see something like 100 and something percent volatility, implied volatility on a stock with a volatility that's much lower, and they realize that those prices are so high, especially if they already have a long option to hedge against, they could sell those options. So again, I showed you what I did. I'm not sure if I would recommend doing it. So here's a JBL trade. I bought these at 680. I flipped them out at 1670, and that came to a gain of 310, and then I rolled them down. So that's the original trade here, and then one of those was unloaded at 30. We were blessed with a pretty decent profit on that, and so we add up all that math, and it comes to 3310 on the position. So we sort of beat the service. We beat just trading the underlying, by using options and rolling down. And I still have one option that's on. Oop, I forgot about the remainder put. So 2139. So we're still beating the underlying, which was like 1300, I think. And I still have one option on after the big retrace rally. So the options can give you some staying power. It's like I didn't throw caution to the wind. I had an option on. It was paid for. It was the mother of all rallies. I knew it likely wouldn't hold. So I figured it was worth a shot instead of trying to cash out at the absolute worst time on that option. I know you can't get a little bit pregnant, but if it is open profits, you treat them, or you can treat them a little bit differently if that's helping you to stay in the game and possibly make even more open profits. So hopefully that made some sense. I know I confused myself. Real quick, we've been talking about timing and trading with the VIX. The VIX only matters as I preach when it matters. So here we have the VIX in this funny looking chart. I don't know what these charts are, but it just came up as that. And the S&P 500 is a line chart in the background, and the 10-day simple moving average is based on the VIX. And as I've said ad nauseum, I did a lot of research into the VIX inspired by Larry Connors years ago, and I was actually working with Larry on some of this stuff, and I created a lot of stuff on my own. I would play around with it, and Larry had said that he explained to me that it was a reversion to the mean type of market. And so I took that quite literally, and the mean being a moving average, and I did a lot of research, and I found the 10-day simple moving average is a really good metric for the VIX. Now, as I preach, it only matters when it matters, but when you see these extreme stretching like we did, I think it was last August, I think it was around 60 or something on the VIX, but when that thing stretches from the moving average 10% or more, you look for a reversion to the mean. Now, if it stretches 100% or more, in this case 150% or more, get ready because that market's getting ready, that volatility is getting ready to implode, okay? And then stocks are getting ready to rally. So in this case, we had obviously the mother of all rallies yesterday from that super duper stretched VIX. So again, I'm not going to beat the dead horse on this. So it is a reversion to the mean market. I see people draw double tops and double bottoms and head and shoulders and other stuff. That doesn't work in the VIX because you're looking at volatility, and that behaves much differently than price. The VIX only matters when it matters, and high and low is relative. And through this cycle recently, a lot of people have been posting things about VIX more than 20. That's bullish. VIX less than 20. That's bearish. And it's like, doesn't work like that, okay? So high and low is relative. Use a moving average or some sort of metric. Use an oscillator if you want. Oscillators are fine for this. Usually I don't like oscillators, but an oscillator is absolutely fine. You know, don't be a hero. VIX is at 60. Let's short it. No. Let it implode. I would only do intraday trades too on something like this, although you can get a major bottom on a spike. Now, do use it as a gauge for overbought, oversold, especially oversold like we just saw. So that can be kind of neat. Real quick, I'm not going to walk through all the details of this, but there are your signals. You can go in and watch the last 30 methodologies in actions or 50 methodology in actions on my YouTube page for more on this. But this did stop out last Friday. Now, what's painful here, as I said ad nauseum, is that when I did the research, it was done on a calendar basis. And so I followed the system on a calendar basis, and the sell was way down there. Now, the only thing I did, I had some leftover college funds for my girls, and I pulled their college funds last Friday based on the system. And this is how I've been managing those funds, because people always ask me, Dave, do you do anything long-term? I'm like, no. It's like, I can't believe you don't do anything longer term. It's like, well, okay, I did the Q trade a couple of years ago, which just stopped out. And then I do it to stop me from going in and out and trading like a madman with my girls' money. I just keep them in this system, put them in an aggressive mutual fund when things are doing well, and pull them out when they get iffy and ride it out. He who fights and runs away lives to fight another day. So that sell was way down there. The Qs, which I've showed the trade before, and I think it was a 50-something% gain. The Qs were a little cooler because they stopped out kind of like with the designer's intent. The designer's intent was to only lose about 10% on the trade. That P's trade that just showed you, so to speak, lost a lot more than 10% because it didn't trigger right away. But you can see there it is right there below the 50 simple and below the 10% line, 10% of the 50-week moving average. Anyway, that's that system. I know I rushed through it, but I've talked about that ad nauseum. Okay, Landry 100. I probably started it at the world's worst time, right into a bear market. And that's probably what had me giving up before. And I think the software I was using was no longer made. And so I don't have the greatest software anymore to do this, but I'm able to accomplish the proof of concept, and it helps me to pay attention to where the momentum is and where the money's flowing. And that's the whole kind of proof of concepts to the Landry 100. And I'm just buying brand new highs with this. Okay, so take a look at AGI. The stock that we just talked about a few minutes ago is not a mystery chart. So that was bought on 3.5 when it was making new highs. Now, as I've said ad nauseum, I don't recommend you rush out and buy new highs as a private trader, unless you could buy like 100 of them at a time. And this is all hypothetical. I did experiment with a little bit. It failed miserably so far, and we'll see what happens. But for the most part, this is just all hypothetical. So the buy was there. Again, I wouldn't buy just one stock at a breakout. If you're going to do that, you need to buy 100, okay? And statistically, one of you guys was a while back was saying, well, statistically, you won't have to buy 100, but I don't know what that magic number is. I'm always nervous when you try to use statistics in a market. Easy for me to say because markets aren't normally distributed. Also, statistics are worthless. 73.4% of all people know that. Anyway, the buy was there, and knock on wood, it's had a pretty good little run so far. Now, one thing kind of cool, before we get to that, notice right here, I zoomed in on this little area down below, and it's a Landry 100, right? Well, there's only 61 stocks in there. So what happened was lately, I've been pulling stocks out, and I haven't found any that I want to put back in. So I do treat cash as an asset class. So there's 100 slot, 39 slots are in cash, okay? And then the 61 remaining are still in stocks. Now, what's kind of cool is if you zoom in, and we've been talking about this quite a bit, but this is one kind of cool thing about doing an experiment like this. And notice up here, this asset management, this is actually a physical gold too. All of these are golds. What's about the only area rallying right now? Gold, and that's it, right? So this is putting you in those golds. And also, if you take a look at like groceries and some healthcare stocks, although healthcare is not doing well, but these are more defensive type of issues. People still have health troubles in bear markets, and people still eat. And I think there might have been a tobacco company in here at one point in time or not that long ago. People still smoke, and some people smoke more. Now, it's kind of interesting. There are a few biotechs in here. Biotech's kind of a weird sector. As a general statement, you want the sector behind you when you're trading, right? But sometimes biotech can have a few little standouts that defy gravity. So we'll see how these work out. Where are they? They're right here. But so far, it looks like they're not working out so good. So those might actually get pulled. But there are a few biotechs in there that have showed up. All right, random thoughts. We'll just run through quickly. Momentum does end badly. And when I initially put that in here, it's by ended badly, I mean that in the end, you give up some of that trend when you stop out. You still make 100%, but you don't make 140% or whatever you were up here. You give up a lot of that in the end. We did have one a couple of weeks ago that just absolutely imploded, lost 95% of value overnight. So that can happen. It happens, you know, with a silent SH. Relative strength of the bear market is okay, but they eventually find you. You notice those biotechs really wasn't doing that well. And that's because they were doing okay, even though the market was doing poorly, but eventually the market will drag down all stocks. The only exception might be a commodity related stock that could head higher. So there's always a bull market somewhere. That's one of the myths I put into the layman's guide to trading stock. There's not always a bull market somewhere. It's still a great way to see money flows, and cash is not trash. And trash, and again, it's treated as an asset class. All right, any questions at all? I know I threw a lot out. Let's see what we have here. Let me check in here. Oh, lots of questions. Okay. Okay, a debit vertical spread is always a great directional strategy because you are passing off some of the risk to someone else. The stock probably won't go to infinity. Passing off reasonable upside risk is a good move. Okay, all right. Yeah, we'll have to talk about this more offline. That makes sense. A debit spread, you are selling the delta, gamma, theta, and vega. Well, I know what some of those are. Yeah, that there's always something to do with options, and you know it's fine. I find that the best option traders tend to be more like brainiacs and engineering type. Like I think Larry Millen is an engineer by trade, or was before he became a trader.